Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Marlon Nichols of MaC Venture Capital. MaC is a seed stage firm that invests in tech startups, leveraging shifts in cultural trends and behaviors. In this episode, we discuss the origin story of MaC VC, how Marlon tapped mentors for access to LPs, why it's so important to do what you say you will do when building LP relationships, how launching Fund One is basically like building a startup, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or Fundingstack.com if you are a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool to get warm introductions to investors, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Marlon.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite and Fundingstack.com. Today I have Marlon Nichols of MaC VC coming to us from LA. How's your day going?
Great. How's yours?
So far, so good. So far, so good. You're my first thing other than getting kids to school. So that's a good way to start off the day. Yeah.
Nice.
Well, right on. Well, let's just jump right into it. What is MaC VC?
Yeah. So MaC Venture Capital is a seed stage venture fund founded in Los Angeles with a very strong presence in the Bay Area. We're a team of 10. We like investing in, high quality founders that are building category leaders across a number of sectors. We consider ourselves a industry agnostic firm, leaning more towards software than hardware, but we do some hardware as well. Sectors where we spend most of our time, I'd say aerospace, defense, hard tech, deep tech, AI, fintech, digital, healthcare, I'd say logistics, and some media platforms.
Got it. That's pretty diverse, right? Media to aerospace and fintech in between. What's the commonality of the companies you're investing in? Is there kind of a pattern there?
Yeah, we have a thesis that we coined cultural investing, and it's a play on like dissecting what popular culture is, right? So popular culture is basically a group of behaviors that have become social norms that are now popular. And so what we try to find in all of our companies is behaviors that humans are taking today that we believe they'll continue to take in the future. And if we can identify the right ones, we're essentially identifying where people and businesses are going to spend their time and their money going forward. And if you do that correctly, you end up selecting, tomorrow's next great companies.
Interesting. Okay, let's unpack that a little bit. What does that mean? Can you give a couple examples, or that's definitely an interesting thesis.
Yeah. One easy way to kind of illustrate this is using Slack as an example, right? So we're all now text messaging is just everywhere, right? When Slack came out, text messaging was a big thing in Europe. It was a big thing in places like Africa that didn't have smartphones, et cetera. But more and more people were texting outside of the workplace. And if people are taking actions outside the workplace, they're going to end up taking actions within the workplace. Those same actions in the workplace, they'll want the same experience, right? So it made sense that Slack would become the type of company that it ultimately became, because it's grounded in human behavior that is a part of popular culture.
Okay, makes sense. Interesting. Any other examples, or if you will, maybe talk about a cultural trend that then translated into one of your portfolio companies or an investment, maybe. Yeah.
I mean, there's so many. I've been spending a bit of time on the continent of Africa and making investments there. And one of my most recent investments is a company called Carrot. And so let me back up. So in Africa, generally speaking, and many other emerging markets, the concept of revolving credit, think credit cards, does not really exist. And that's because lending is usually collateralized against hard assets like homes, et cetera. And obviously not everyone owns homes in an emerging market, right? So, or have, big savings accounts and things like that, right? And so what this company, and so also what's happening is that you have a very young population and a population that's growing rapidly. And that young population is very mobile forward. They are increasingly investing in public equities and in other kind of investment things, crypto, et cetera, right? And so this company had the idea that, all right, let's capitalize on those behaviors, the mobile first and the kind of the desire to be more digital in their investment activities. And so what they've done is they've created a revolving credit facility that's collateralized against those digital assets, right? So Robinhood's not in Africa yet, but there's the equivalent is a company called Bamboo. Africans are able to invest in the U.S. And other stock markets through this company, Bamboo. So what Carrot does is they partner with Bamboo and others to allow their customers to borrow against their digital profile, right? So now you're introducing the concept of revolving credit cards. It's still collateralized. It's still safe for Carrot and Carrot's investors, right? Because it's there's a lien against the let's say your stock portfolio, right? And they're monitoring that many times daily. And there's a certain level at which you can borrow again. So I used to call it 30% of the value of your portfolio. Mm-hmm. So that's another example of watching these consumer behaviors and these trends and making a kind of an educated guess that these trends are going to continue well into the future, and backing a company that's poised to take advantage of it.
Yeah, makes sense. Yeah, totally. What if you're willing to share? What do you have any theses on current trends that are kind of? I guess what are you looking for going forward? That's definitely interesting. Yeah.
Well,
looking
AI is another.
Yeah.
AI is another one that a lot of folks are talking about these days, right? And with AI comes certain consequences, right? Data centers need to pull more energy now, right? And the more intense these models get, the more energy needs to be pulled. And so I think my thesis is that we're going to need to use AI to modulate or regulate the way that the energy is flowing through those data centers. So I think there's a big play in energy, both from software and kind of a new sources of energy, fission, et cetera, that I think we need to start paying attention to, and I think we can find a pretty big winner in that category.
Okay, interesting. That's bold and brave space for sure. I don't know much about it, but it sounds like it. Cool, very good. Let's talk a little bit about your journey into VC. I was kind of looking at your LinkedIn. I saw Intel and then Kauffman Fellows. I don't know where you want to pick up the story, but kind of how'd you get into VC?
Yeah. So the way that I learned that I wanted to get into VC was, through trial and error from two previous careers. So right out of undergrad, I joined a startup, enterprise software company, and that was at the seed stage, and led global implementation for them. And then ultimately, they raised a Series A. We expanded to the UK and kind of helped build the business there and grow it. And the company was acquired. And so that was an experience of working with one product day in and day out, selling it, implementing it, like doing all the things, right? And what I realized is that I need more variety in my day to day, than that. So I didn't want to lead or to operate a single product company going forward. So I moved back to the U.S. I lived in London for 2.5, 3 years, somewhere around there. Moved back to the U.S. And became a consultant. And first it was kind of post M&A integration work, and then it was strategy work for media and entertainment companies. And what I learned through that about myself through that process was I swung a little bit too far in the other direction. There's a real contrast there, right? Because as a consultant, you're working with smart people, you're working with executives, you're tackling their toughest challenges, but you're not around for what happens after you develop a strategy, right? Like, do they implement it in the way that you designed? Do they implement it at all? And that just felt too disconnected from the outcome for me. So I was searching for what's in the middle, and I landed on venture capital, and I just saw it as a way to continue to work with smart executives. Working with people that are looking to change the way that things are fundamentally done, working with cutting edge technology, being a part of strategy and high level operational conversations, having skin in the game, right? Because we're going to be working with these founders anywhere between 5 to 10 years, maybe even longer. And so you're there to see the outcome. So that's how I thought about the industry. So I went back to business school, chose Cornell because they had one of the few MBA-led venture firms in the country. So real money, real dollars, investing in real companies. And I became the CEO of that fund for a year and a half of the 2 that I was there for business school. And that really allowed me to, one, practice before I was actually, legitimately in the industry. And then 2, build relationships, build an actual network in the space. And I ended up landing at Intel Capital after graduation. Became an investment director there. I was there for roughly 5 years. And it was a great place to learn the business of venture because Intel at the time was investing off of Intel's balance sheet, and we'd get a budget of anywhere from 200 to 500 million per year to invest in, early stage Series A, Series B companies primarily, and do some, one-off bigger investments as well. And so I was just getting a lot of reps, right? Seeing a lot of deals, meeting a lot of founders, working with a lot of companies. And ultimately, I decided that I think I can do this on my own. I think I'd have more fun doing it on my own, investing in the companies and the types of founders that I wanted to invest in. And so, so I left.
I think there's probably a third one there, and I think I'd make more money doing this on my own. I'm reading between the lines.
It is true. It is true. The at the time so I was going through the Kauffman Fellowship at the time, and now I'm learning all about the business of venture capital from some of the greatest that have done it, right? And having in-depth conversations with my classmates.
Actually, I even had that on my note to ask about the Kauffman program. Maybe talk about that. Like, what is it? How does it work? How do you get into it? What'd you learn? Yeah. Tell as much as you can about that, because I think that's kind of interesting.
Yeah. So I'm actually on the board of the Fellows program now, so kind of a full circle experience. But I was class 18. I think we're recruiting for class 30 now. So I went through it some time ago. When I went through it, the program was really set up to help folks that are early in their venture career accelerate and move to the later stages of their career, or folks that were not yet in venture, help them get into venture. So it was a great training ground and a terrific global network to do that. Today, because over the years, you get, enough fellows in the program that are at a senior, stature in their career, where it made sense for the focus of the fellowship to shift towards now we recruit folks that are later in their career. So principals to general partners, right? So principals that are about to move to general partner, or a general partner that's taking on more responsibility at their firm. But it's a 2-year fellowship. There's a curriculum aspect of it where you're learning intimate details of venture from some of the greatest minds and greatest success stories in venture. But then it's also the largest global network of senior venture professionals. So we're talking, folks in Africa, folks in Latin America, Southeast Asia, Europe, etc. There's representation from around the world.
Got it. Interesting. What, just a couple quickies on that and we'll move on to something else. But is it a full-time thing? Is it a unpaid training thing? How does one apply to it? If someone was interested who's listening, what would you tell them to get in?
Yeah, I mean, you apply to it and you have to be working at a venture capital firm and you have to be in a senior role at that venture firm. And you can either pay for it yourself or you can have your firm pay for the fellowship. But you're working in your full-time job the entire time. This is to augment that, right? So they're quarterly in person, we call them modules, which are the learning sessions where you bring everyone together. But then in between those, there's several virtual modules where you're also learning, but you're doing it remotely from wherever you are in the world. And then there's there's an annual convening, which we call the Global Summit, where we'll descend on a major technology and venture hub around the world and bring everyone. And there's programming, there are limited partners there, the GPs, et cetera. There are the government, officials there, et cetera. And it's a big kind of to-do. But yeah, so that's the fellowship program.
Got it. Cool. And then, so if I'm looking at your LinkedIn correctly, that led to launching cross-culture ventures. Is that the next step? Or
yeah.
what?
Yeah, that's right. So yeah, like you were saying before, I looked at the economics, didn't quite make sense. We were on a bonus structure, and you think if you make, you make an investment that makes the firm, billions of dollars, and you get a, couple $100,000 bonus, it doesn't seem appropriate, right? So that was one thing, but for me, it was more so. Because Intel was a corporate investor, a corporate VC, even though we had a lot of rope, you only had so much in terms of what you could invest in and how far away from Mother Intel's strategy you could go.
Yeah.
And there were so many companies, so many founders that I thought, could build like really wonderful things and would be fun to work with that I wasn't able to work with because of that. And so, decided to step away and create something on my own, which was, as you said, Cross Culture Ventures. So I co-founded that with a guy named Troy Carter. Troy's a famous music manager and angel investor. We raised a small kind of $15 million fund and just started to deploy it. Ultimately, we have some good companies in that portfolio. Some we're waiting on to exit in the next couple of years here. But as we got through our investment period, Troy, did some internal searching. He was like, yeah, I like angel investing, don't so much love institutional venture investing. Mm-hmm. And there's so many other things that I want to work on. So I'm going to step away from this. And, he was gracious enough to just hand me the brand and say, hey, if you want to continue to build it, do that. If you want to, shut it down after, we finish, managing out the portfolio, then do that. And so I thought about it, and there was another group in the LA area called M Ventures, which was founded by Charles King, famous talent manager turned, movie creator, and Adrian Fenty, who was a mayor of Washington, D.C., and had been working at Andreessen Horowitz as a special advisor for about 4.5 years. So they came together. They had their thing called M Ventures, and employee number one there was Mike Palank. And so I had actually invested in Charles's company, Macro. So over the years, got a chance to really get to know him, and as an extension, got to know Mike very, very well, because they're both here in LA. Had different interactions with Adrian over the years during this time with Andreessen Horowitz. And I just thought, there's some similarities in the way that we think about investing, in the way that we think about technology and culture. And so I just brought it to them. I said, hey guys, and they had been running two small funds, I think 10 and 12 million a piece. And so, I was looking for, full-time partners that had differentiated skill set and a network that was unique to or different from mine. And they were looking for someone that had been in a traditional venture capital firm and gone through like the traditional venture training, if you would. And so it was like a good match. And we decided to bring our teams together and create MaC in 2019. And since 2019, we've we've raised 3 different funds. We're investing out of our 3rd now, and we manage about $600 million in assets.
That's amazing. That's a big number. Yeah, cool. That's me. What does MaC stand for? Does it stand for something, or is it just
It does. M Ventures and cross culture.
Okay. Oh, okay. Gotcha.
And then if we want to play on words a little bit, right? So you got Mike, Marlon, Adrian, Charles,
right.
which are the co-founders. So.
Gotcha. Nice. Fun. Okay. Let's go back just a little bit in time though, and because I think this is one of the usually the most interesting story of raising that first, $15 million fund for Crosscut. A lot of people, like I mentioned. Sorry, what? Oh, sorry, cross cultures. Cross culture.
Yeah.
Crosscut's a different. Yes.
Yeah, we love those guys. They're down the street.
Talk about that. How do you get that fund off the ground? Because that's the first fund is often the hardest for many. Yeah.
So I've always been a believer in tell everyone who will listen. What you're working on, what you want to build, because the folks that want to help you can't unless they know that you're out there doing it. And so as I was developing the strategy, I went to 2 great friends and mentors of mine, mentioned Freada, Kapor Capital. And, the meeting was really just to get their advice, right, on what this was. And like in that meeting, they committed to investing in the fund. And not only that, but they were like, you know what, there's someone I think we need you to meet. And that was Troy. Initially the meeting was to try to get him to be an LP in the fund. But that ultimately turned into, him wanting to be a general partner in the fund. And it worked out. Troy's still a very close friend of mine. And so after that, I also spoke to Jason Green, Emergence Capital, and Jason was terrific in not only helping us think through the strategy, but making introductions to some of his very first LPs. And some of those are, have become anchor investors in MaC funds now. But it was, it was kind of that. And then I think roughly 50% of my Kauffman class also, wrote like small checks into the fund because they believed in me and what we were building. And then obviously Troy had his own network of folks, and they wrote their small checks into the fund as well. And that, as a result of the mentioned Kapor investment, Google Ventures was creating a program where they were investing in smaller funds at the time. And I think we were the first investment that they made out of that fund, and they matched Mitch and Freada's commitment. So the 2 of them were our kind of anchor LPs for that cross culture fund. But it was it was a difficult process, right? It took us probably a year and a half to raise 15 million, and a lot of that came down to, well, you just met Troy, right? How do we know that this is going to be a lasting relationship? Like, how do we know that the investment decisions that I made at Intel and that Troy made as an angel investor are going to be the same decisions that we make as a team. Mm-hmm. So and I think the team construction and the team cohesiveness and the whether or not that team has legs to run well into the future is usually the main concern for LPs, because if that team doesn't work out, then those LPs are left to manage that portfolio, and that's obviously not what they want to do or what they do. So that was the biggest challenge for us, is like, how do we convince folks that, we can make the right decisions, to invest in the best companies as a team, and that, we're going to stick around and see this thing through. And so that's why it took so long. Most want to see us operating for a while. And so, we got our first close, and we just started investing, right? As a way to show that, no, look, we can make, decisions together. We are still investing in the same types of companies that, our track records, independent track records, have shown that we invested in the past. And I think, over time, when folks saw that, they got more and more comfortable. But it was a 1.5 year process to raise 15 million.
Yeah, that's interesting. Those are great names, though. I mean, Kapor and Jason Green and Google Ventures and all this stuff. What is it? What do you think they saw in you? What do you think they saw in you? Like, why did they invest? Right. This is like one of these sort of squishy questions. But if you were putting yourself in your shoes, what do you think they? I
mean, better question for them, obviously, but I'd say we were taking a slightly different approach than what most had been doing in the industry, and I think at the time, just like the contrast of my background and Troy's background, it felt interesting, right? And I think it was the approach and just a belief that the two of us were capable and could pull this off.
Makes sense.
Excuse me.
Bless you. Did Troy tap his entertainment context? Like, it's kind of trendy these days to have like celebrity investors. Did you guys go down that path at all?
So the one thing we did not want to do was to, there's kind of a conflict of interest, getting his clients to invest in the fund. So we didn't quite want to do that. But there are definitely some folks in his network that were co-travelers, in his professional journey, that we did tap, and they did come into the fund.
Gotcha. If there's anything else to talk about that first fund, or maybe, you guys have gone on to raise, I think your most recent was Fund 3, 150 million. Is that correct?
That's right. That's right. Yeah. Raising Fund 3 for MaC was, in stark contrast to raising Cross Culture 1. And, there are a number of reasons for that. One is that we were fortunate to get a number of institutional investors in MaC Fund 1. And, they saw us perform in MaC Fund 1 and Fund 2, and were inclined to move forward with us and even increase allocations with us for Fund 3. And that's based on us doing what we said we were going to do: invest in a certain number of companies, target a certain ownership percentage in those companies, and actually get it. We said we would work very closely with our portfolio and be hands-on, and we did that. We saw, I think 3 or 4 of our Fund 1 companies exit via acquisition during that time. And then we saw a high number of value appreciation across the portfolio in Fund 1 and Fund 2. And so now you have this track record, of a team that's been together since 2019. So it makes it an easier underwriting decision for LPs.
Yeah. All right. I'm bouncing around a little bit, but maybe talk, if you can, about that Fund 1. So we've gone beyond cross culture. Now we're MaC. Maybe talk about raising Fund 1 and I'll start with this question. Were you going after high net worth folks? I think you mentioned you had some institutional LPs. How did you kind of identify the right institutional LPs? Yeah, go.
Yeah, we had a mix, right? So the makeup of Fund 1 was we had fund of funds, we had large university endowments, we had pension fund, we had foundations, and some high net worths. When we went into that fundraising process, we wanted to target institutions because typically when an institution that has a history of investing in venture capital commits, they're actually underwriting multiple funds, right? You have to perform, you have to be a good partner, But if you do those things and, things, I guess macro things don't change too much for them, then they'll be back for 1, 2, 3 funds, right? And so our focus was like, really, we have to get that caliber of an investor. And if we wanted to get to, we're targeting, I think, between 75 and 100 million, and we ended up at 110 for Fund One. And to get to those numbers, you're not going to be able to do it with just high net worths, right? You're not just going to be able to do it with small family offices. Like, you need the institutions. And so that was our focus. That was our target, and we went after them. It took us about 1.5 years, and and we had a pretty big hiccup during COVID when everyone stopped investing, right? Like, the world just stopped for about a 6-month period of time. Fortunately, we had a first close before that and made some investments. And one of those investments went from 13 million valuation to 2 billion. In that
was that Zoom? I mean, what was it? Yeah, that's crazy.
No, it's a company called Pipe. At the time, they were they're still embedded finance today. They can do kind of near to real time working capital lending to small and medium sized businesses. They just have a unique way of gathering real time data to make the best decisions. So that company went crazy. And so now, we're still open in terms of taking in investments, right? And so there are folks that we had been talking to for a while that were kind of on the fence, and then saw that happen. I was like, okay, well, I see the outcome here. So let's jump in. And so that's how we ended up closing out Fund One. It was, we're fortunate in some way.
Yeah, no, it's great. Any tips now? Any tips for people listening to this? Maybe they're trying to raise Fund One and they're trying to go after institutionals. Any tips for finding and getting in touch and or closing, pensions and foundations and fund of funds? That's a tricky path, right? Yeah.
Yeah. I mean, you got to kiss a lot of frogs to find the prince, right? So, we did a lot of research to qualify different institutions, right? So, who are the institutions that have invested in Fund Ones, for instance, right? Who are the institutions that don't have a lot of exposure to Los Angeles as as an investment hub? And we have other criteria, but we kind of took this universe that was out here and brought it in and narrowed it, which was still a lot of folks. And then we went to, the investors that we had all been talking to when we were running our independent, funds. For instance, Dan Feder, who, leads privates at the University of Michigan now. I met Dan, all the way back in 2015 when we were raising Cross Culture One. He was at Washington University at that point. And, we just developed a great relationship. He wanted to invest with us then, but we just couldn't make the mark because of the things I mentioned before. And, once he got to University of Michigan, we kind of picked up the conversation. Now I had this other platform that we were building. And, so just the work of building that relationship over time. And by the way, Adrian had his own relationship with Dan too. So, the kind of the two of us working that independent angles. And, Dan was our anchor investor in Fund One, and University of Michigan has been an anchor investor in all 3 funds to this point. Right. So, it's developing those relationships from before and then seeing them bear fruit, for MaC Fund One. And then, my other partner, Mike, he was great at just the cold outreach. So, we prioritize investors based on the criteria I mentioned earlier. And then he would just put together these emails and just reach out to as many folks as he possibly could. And sometimes we would get hits. I don't know how many of those converted to actual investors over the years, but I believe some of them have. So there's that. And then, Adrian and I just tapping the investors that we already had and getting, introductions to folks that they thought fit our criteria, et cetera. Going through the Kauffman Fellows program, there are a number of LPs that also go through that program. So I was able to connect with some of them there. Melissa Richland at MacArthur Foundation, for instance. We had developed a relationship over the years, and she was able to get them to take a look at what we were doing, and their team saw value in it, and ultimately invested. So it was a multi-pronged attack that we engaged in, and it ultimately worked out with a little bit of luck too, right?
Sure, yeah. One of your portfolio companies blowing up, that always helps when you go into those pitch meetings, right?
Yeah. Makes for a really good story.
That's awesome. I won't keep up too much of your time, but any other tips if emerging, and you could take this anyway. I asked this question in kind of a long-winded way. Any tips you would give your younger self if you were doing this all over again, or any other tips you would give, emerging VCs trying to break in, raise that first fund, or if you want to, any tips for, we haven't really talked about any for persons of color, or, anything like that. Anything else to cover that we haven't got into? Any tips?
Yeah, I'd say the couple things. One, just do the work up front to make sure your vision and your partner's vision are completely aligned, and that you guys are seeing the opportunity in the same way, right? Because as I mentioned, the team is the biggest. If we're building a product company, right, you could say that the widget that we're building is the most important thing, right? And then second to that is, can this team deliver that widget to the market and build a great company? Well, we are the widget, right? Our partnership is the widget. Yeah. It's our brains, right? And so you've got to make sure that that product is, it's an ironclad product that the market can believe in, right? So really understand your partnership, and make sure your values are aligned, the mission's aligned, and the thing that you want to build, that you're aligned in that. And then after that, I'd say try to. I know that Fund One, you're basically a startup, right?
Yeah.
But build it. Start putting the kind of foundation in place to become a true institution, right? An institution grade venture firm. The more of that you can do up front, the more, I guess, confidence that you will inspire in those LPs that are looking to take a chance on you for your first fund.
Give an example of what that means. Like, what does it mean to be an institutional grade venture fund?
Yeah. So, I mean, like, you're reporting, right?
Okay. Yep.
Every quarter, we've got to provide financials. Not only did we provide financials, but we write a memo to our investors, which basically gives a voiceover to the numbers that they're seeing. We give some details on what's happening with, companies in the portfolio, right? We hired a fund administrator, a well-known one that was within our price range at the time, to produce the reports, in a way, and do the fund administration type things, right? When we would make capital calls, we're very clear as to why we're making them high level, but we're clear as to why we're making them. We found ways. We got a working, not working capital, but a capital call line of credit from our bank, so that we could smooth out, the cadence in which we would make capital calls, right? So we do that quarterly, as opposed to having to, bother our LPs every time we're going to make an investment. Yeah. No, we use the line to make those investments during the quarter, and then we call capital to pay back that line. So it's things like that, right? Putting together, a hiring plan, right? So what's the team eventually going to look like, and what is the budget, to operate this fund? It's all of those things.
Yeah, good. Excellent. Any other just tips, general bits of advice we haven't covered? There's a lot of good stuff here already, but.
Yeah, I think we can leave it there.
We got it. Okay, cool. If people actually, two-part question. If people want to learn more, where should we point them? And anything you want to either promote, plug, call for, startups doing XYZ to reach out? Anything at all?
Yeah. To get in touch with us, it's just macventurecapital.com. If you're a founder that's not in our network, but you feel like you fit in with what we like to invest in, you can submit your information right from our website, and we take those submissions pretty seriously. We've made investments that have come to us through that channel in the past, and hope to do it in the future. We definitely believe that, while talent is ubiquitous, access to capital is not, and we want to close that gap. We don't want to miss out on great companies because they're not yet in our network. So that's how you reach us, and that's kind of our philosophy on changing the way that, in some ways, that venture capital is done today. In terms of what looking for, I'm heavily focused on AI for fintech and digital health right now. I'm actually also looking at one in the media space. So we'll see how that goes. But I just think there's so much headroom in those sectors where AI can be very, very valuable. So looking at that, and as I mentioned, software around energy.
Oh yeah. Okay.
Yeah.
Excellent. This has been fun. Marlon, thank you so much. This is fun to hear your journey, and we'll catch you after Fund 4, Fund 5. How about that?
Awesome. Looking forward.
Cool. Thank you, sir. Appreciate it. Over and out.
Yeah.